While everyone was distracted by the Supreme Court ruling, the market told you exactly who was in control. The court ruled Trump's emergency tariffs illegal. Silver dropped to $79.80 on the news. And then, within the same session, it was bought back ferociously to $84. Gold closed the week at $5,100. The COMEX Vault Drain continued without pause. And UBS just put a number on the silver deficit that most people are not going to process correctly. Let's go through all of it. Before we get into the data, something needs to be addressed directly, because it speaks to the integrity of the information you are consuming. There are imitators out there, same thumbnails, borrowed language, stolen clips. That is what happens when something is worth imitating. But copies always expose themselves in one of two ways. Some want your money, a signal service, a course, a private group, a members-only tier. That is the obvious tell, and it is not subtle. Follow the incentive, and you find the agenda. If the analysis is designed to sell you access, then the analysis is marketing, not research. And then there are the others. They are not after your wallet. They are after your attention. They repeat the language. They mimic the format. They sound familiar because they are translating work they did not produce. But when the market moves, when price reaches a critical inflection and clarity is needed most, they go quiet. Or worse, they explain it after because they did not see it before. That is not analysis. That is narration. And narration after the fact is not the same as reading the tape in real time. Translating someone else's work without understanding it is more dangerous than the one selling something. At least the person selling a signal knows he is running a business. The imitator genuinely believes he understands what he is repeating, and that belief is where his audience gets hurt. Nothing is sold here. No signals, no courses, no member access, no private videos, no premium tier. That absence is how you know you are at the source. Now let's get into it. For the tape readers, one candle, one level, verified. Before the data, I need to address something for the people who have been watching the tape with me. Go back and watch the last video. I told you the lower time frames were looking constructive. I told you the structure was intact. But I did not stop at a general thesis and leave you to figure out the levels. I narrowed it down to one specific candle, the 3 a.m. New York local time hourly candle, not 2 a.m., not 4 a.m. That exact candle for a specific reason. It reclaimed the high. Its low became the line. That is your invalidation level. Everything above that candle meant the structure remained intact. Everything below it meant the thesis was compromised. That is not a zone. That is not a range. That is not 100 hedge scenarios designed to let someone claim they were right, regardless of outcome. That is one level. Now look at what happened at 10 a.m. New York local time today. Where did price bounce from? That same candle. Exactly there. We are now trading at $84, one call, one candle. Verified in real time during a session that had every reason to break down. A Supreme Court ruling that struck down the primary tariff mechanism. A flush to $70, $80, and price held the level I told you to watch and recovered $4 in the same session. This is the part the imitators cannot replicate. They can repackage the thesis. They can borrow the format. They can recycle the vocabulary, but they cannot replicate the precision, because precision does not come from watching someone else read the tape. It comes from years of sitting in front of a screen at 3 a.m. and learning what a candle is communicating when the market is at its thinnest and most honest. It comes from understanding not just what a level is, but why that specific level matters in that specific context, on that specific time frame, at that specific moment in the larger structure. When I point to a single candle, not a zone, not a general area, not a hedged range, and price responds exactly there during a session driven by a genuine macro shock, that is not luck. It is not arrogance. It is the product of doing this long enough to hear what the tape is saying before the rest of the room processes it. That is what reading the source code sounds like. If you have been here long enough, you already understand the difference between someone who reads the tape and someone who reads the explanation of the tape after it has already moved. The COMEX Vault Drain. What the numbers are actually saying now. Let's talk about what this week's price action in silver is actually communicating, because the vault data tells a story that the paper price alone cannot. COMEX registered silver, the metal that is warrant issued and genuinely available for futures delivery, not just held in custodial or eligible accounts, sits at 88.19 million ounces. To be precise about that distinction, registered silver is the specific category of vault inventory that can actually be called upon to settle a futures contract. Eligible silver is metal stored at COMEX-approved vaults, but not currently warranted for delivery. When people talk about the COMEX running out of metal, they are talking about the registered category. The 30-day change in total COMEX silver inventory is negative 51.9 million ounces. That is a 12.4% drain in a single month. Not a quarter, not a year, 1 month. And the recent single-session data shows another 1.4 million ounces pulled from vaults simultaneously across multiple custodians. Multiple custodians moving simultaneously is not routine housekeeping. That pattern reflects organized demand, not random individual withdrawals. The coverage ratio, registered silver measured against open interest contracts, is now 0.14. Let that number translate into plain language. For every contract that is theoretically entitled to demand physical delivery, there is a fraction of the actual metal in the vault system capable of satisfying it. Not a large fraction, not a comfortable fraction. A fraction of 0.14 means the physical backing of the paper market is extraordinarily thin by any historical standard. Verify this yourself. COMEX inventory reports are published daily and are publicly accessible on the CME Group website. The data is not behind a paywall. It is not proprietary. It has been sitting in public documents the entire time, available to anyone willing to look. The reason most people have not processed it is not because the information is hidden. It is because they are not looking. A coverage ratio of 0.14 does not mean default is tomorrow. Markets have mechanisms: cash settlement, contract rolling, sourcing metal from outside the COMEX system that prevent immediate failure. What it does mean is that the structural relationship between the paper price of silver and the physical reality beneath it is under extraordinary stress. The drain is not a recent phenomenon. It has been building across multiple reporting periods, and as of this session, it continued without pause. The Supreme Court ruling. What the mainstream is missing here is where the Supreme Court ruling connects to this picture in a way the mainstream financial commentary is missing entirely. The court struck down the emergency tariff mechanism used to impose broad tariffs rapidly. The potential refund exposure on tariffs already collected runs as high as $150 billion. If large refunds are approved through legal proceedings, the government faces a revenue shortfall requiring additional borrowing. That means more Treasury supply entering a market that is already navigating a significant debt trajectory. More supply at the margin puts upward pressure on yields. And rising yields at this particular moment in the fiscal cycle are not a minor inconvenience. They compound an already stressed picture. On the other side of the ledger, removing broad import tariffs theoretically reduces some inflationary pressure over time because imported goods get cheaper at the margin. That should be deflationary for consumer prices. So the ruling creates two simultaneous forces pulling in opposite directions: disinflationary pressure on goods prices, and inflationary pressure from the fiscal side through higher borrowing costs. The net effect is not clean, and the timeline on each force is different. The critical thing to understand about this ruling is what it does not change. The administration has publicly stated it will deploy alternative mechanisms. Section 232, the National Security Authority, and Section 301, Unfair Trade Practice Authority, remain legally intact and are already actively deployed. These channels are more legally tested and in many ways more durable than the emergency tariff mechanism the court struck down. The pace and breadth of tariff imposition will change. The underlying policy direction does not. This matters for metals because prolonged trade policy uncertainty, regardless of which legal channel it flows through, keeps capital actively searching for assets that sit outside the disruption radius. Physical gold and silver are stateless. They have no issuer. They carry no counterparty risk from a policy decision in Washington. When the rules governing global trade are in active contestation across executive and judicial branches simultaneously, the institutional rationale for holding monetary metals does not weaken. It strengthens. Silver's answer to the ruling was unambiguous. The initial flush to $79.80 found immediate aggressive buying. Price recovered through $81 through $83s and is now at $84. That is a $4 recovery within a single session from a genuine negative macro headline. When a market absorbs bad news and reverses that sharply, it is not a technical accident. It is the demand structure beneath the paper price making itself visible. The buyers who came in at $79, $80 were not retail participants chasing a dip. That speed and that size, immediately following a Supreme Court ruling, reflects institutional positioning. The UBS 300 million ounce deficit, putting the number in context. Here's where the story escalates beyond what most people are currently tracking. UBS has published its silver deficit forecast for 2026, 300 million ounces. Let that number sit for a moment before processing the context around it. Annual global silver mine production is approximately 800 million ounces. The UBS projected deficit of 300 million ounces represents roughly 40% of everything the entire world extracts from the ground in a full year, not 40% of a single country's production, not 40% of one sector's consumption, 40% of total global annual mine supply as a deficit, as the gap between what the world needs and what the world can produce. If 2026 plays out at the UBS projection, it will mark the 6th consecutive year of silver running a structural deficit. 6 consecutive years, and that 6th year would represent a deficit 2.5 times the size of the estimated 2025 shortfall. The imbalance is not holding steady. It is not contracting. It is compounding, growing faster year over year while the above-ground stockpiles that were absorbing the gap continue to draw down. The structural drivers behind this deficit are not speculative. They are documented across multiple institutional research desks. Industrial demand from solar panel manufacturing has expanded dramatically and continues to scale. The photovoltaic industry consumes silver in quantities that have materially altered the demand picture over the past 3 years. Simultaneously, electrification trends, EV production, grid infrastructure, consumer electronics continue compounding on the demand side. Mine supply cannot respond at the same pace because new silver mines require 8 to 12 years from discovery to production. The investment made or not made in mining capacity a decade ago is the supply ceiling you have today. Howard Marks wrote in Mastering the Market Cycle that the most dangerous phrase in investing is, "This time is different." But he also documented with precision how genuine structural shifts do eventually force price discovery that paper markets have suppressed for extended periods. The silver deficit cycle is not a retail metals newsletter theory. It is a verified, multi-year, institutionally confirmed data series. Check the UBS projection directly. Do not take my word for it. Gold's historical weekly close. What this moment actually represents. Gold's Western spot price closed the week at $5,100. Want to be exact about what is historically significant here because the precision matters. We have seen higher intraday gold prices. Gold touched $5,600 earlier this year. But an intraday extreme is not the same thing as a weekly close. A weekly close, the final settlement price at the end of a full trading week, after every participant on the planet has had the time to respond, reposition, hedge, and decide where they want to hold their exposure going into the weekend, that number carries different informational weight. It represents sustained conviction rather than a brief push. It represents a price level the market collectively decided to accept and hold, not just touch. A weekly close above $5,100 has never happened before in recorded market history. Open a free charting platform right now and pull up gold on the weekly time frame. Look at every weekly close on that chart going back as far as the data runs. This week's close is the highest ever. In a week when the Supreme Court struck down the administration's primary tariff mechanism. In a week when the dollar posted its best performance in months. In a week when there were legitimate macro reasons for the physical asset complex to sell off. Price did not sell off. Price closed at a new all-time weekly settlement. That tells you something about the demand structure. It tells you that whatever the dollar did, whatever the Supreme Court ruled, whatever the short-term noise looked like, the capital allocating toward gold at this price level is not trading the news. It is positioning around something with a longer duration. The honest resistance case. The resistance case deserves a serious treatment because the people who manage real capital account for it rigorously, and so should you. A stronger dollar creates mechanical headwinds for metals priced in USD. When the dollar appreciates, commodities denominated in dollars become more expensive in terms of foreign currencies, which suppresses demand at the margin from international buyers. This is a real force, not a theoretical one, and the dollar posting its best week in months is not a small data point. If alternative tariff mechanisms are deployed quickly and trade uncertainty resolves faster than anticipated, some of the institutional safe haven demand currently supporting metals could rotate back toward risk assets. If the picture stabilizes, if Section 232 and 301 actions provide a clear and predictable trade framework, the premium embedded in gold and silver for policy uncertainty would logically compress. Silver's sharp intraday reversal from $79.80 to $84 is a genuine positive signal, but it can also produce short-term profit-taking pressure before any continuation. $4 recoveries within a single session are not typically followed by immediate additional upside without some consolidation. Markets do not move in straight lines, and expecting them to rewards the impatient with losses. The UBS 300 million ounce deficit is a projection. Projections carry error ranges. Supply responses can emerge faster than anticipated if prices stay elevated long enough to justify new mine capital. Demand adjustments can occur at the margin if industrial users find partial substitutes or reduce consumption. These are real variables, and acknowledging them is not bearishness. It is intellectual honesty. This is financial warfare education, not investment advice. Every decision you make with your own capital is entirely your own responsibility. That is not a disclaimer inserted for legal protection. It is a statement of principle. You should not be giving anyone authority over your financial decisions. Not me, not an institution, not a newsletter, not a signal service. The counter. What the data is actually saying. The counter to that resistance case is grounded in verifiable data, not sentiment or theory. The vault drain is reported, not projected. The COMEX numbers come from daily published reports, not from an analyst's model. A 12.4% drain in 30 days with a coverage ratio of 0.14 is not a forecast. It is a current reading of the physical inventory against the paper market that sits above it. The UBS deficit forecast comes from a major institutional bank with significant resources dedicated to commodity research. This is not a retail metals newsletter running a premium subscription. UBS is projecting this figure because the industrial demand data, the mining supply pipeline, and the structural trends in photovoltaic manufacturing support it. When an institution of that scale puts a number on a deficit projection, the methodology behind it is not built on optimism. Gold's highest weekly close in market history is a price chart fact that anyone with internet access can verify right now on any free charting platform. It is not an interpretation, it is not an opinion, it is a data point on a chart. And silver's buying response to the post-ruling flush was not tentative or gradual. It was immediate and aggressive. The character of that buying, the speed, the size, and the fact that it began while the news was still being processed by the broader market is itself informational. Tentative buying looks different on a tape than institutional accumulation. This was not tentative. These data points do not exist in isolation from each other. They are converging. The vault drain, the institutional deficit projection, the historical gold close, and the quality of silver's reversal are not separate stories. They are different expressions of the same underlying dynamic. The physical asset complex is under genuine demand pressure at a moment when the paper market's relationship to that physical reality is structurally strained. What the data is showing. Heading into next week. Here is the summary of where each data series sits as this week closes. COMEX registered inventory has drained 12.4% in 30 days. The coverage ratio is at 0.14. Multiple custodians moved simultaneously in a single session, pulling another 1.4 million ounces from the vault system. That pattern of simultaneous multi-custodian withdrawal does not reflect random activity. UBS is projecting a 300 million ounce deficit for 2026. That would be the sixth consecutive year of structural shortfall and would represent 2.5 times the 2025 deficit figure. A compounding deficit in a market where above-ground stockpiles are already drawn down is not a benign backdrop for paper prices trying to stay below physical reality. Gold posted its first-ever weekly close above IV $1,100. In a week defined by a Supreme Court ruling against the administration's primary trade policy tool. In a week when the dollar rallied. That close is a fact anyone can verify. Silver absorbed a ruling-driven flush to $79.80 and recovered $4 within the same session. The character of that buying, its speed, and its immediacy carries tape-reading significance beyond the price level itself. The unresolved question going into next week is how quickly alternative tariff mechanisms materialize and through which legal channel. The Supreme Court ruling did not close the trade policy story. It changed its form. Watch Section 232 National Security Actions as the most legally tested and most durable path for expansion. That story is not finished, and its next chapter will move the metals complex. The pace may slow. The direction has not changed. Do the work, pull the COMEX Vault reports. They are published daily. They are free. Verify the 4% drain. Verify the coverage ratio of 0.14. Look at the single session data showing simultaneous withdrawals across multiple custodians. Find the UBS silver deficit projection independently. Read their methodology. Understand what assumptions underpin the 300 million ounce figure and decide for yourself whether those assumptions are reasonable given the documented demand trends in photovoltaic manufacturing and the documented constraints in the mining supply pipeline. Open any free charting platform. Pull up gold on the weekly time frame. Look at every weekly close going back as far as the data extends. Find this week's close and tell me where it sits in the historical sequence. The ones who do that verification realize quickly that what is being shown here is not analysis built on opinion or positioned for emotional effect. It is data that has been sitting in public documents the entire time. COMEX reports, institutional research, price charts, available to anyone willing to do the work of looking. The market does not care about narratives. It does not care about what anyone expected or hoped. It runs on the relationship between supply and demand, between paper claims and physical reality, between the capital seeking safety and the assets capable of providing it. Those relationships are where the price is going to go. The data is showing you what those relationships look like right now. Invest with logic, not hype.